You kind of scared me recently, and when you wrote that you could see stocks falling 40% from present levels, in other words, roughly cutting what we've got right now in almost half. Why are you so bearish?
Well, first of all, we had on June the 9th a break, and it's interesting that the week before I had come out and said that these FANG stocks and related stocks like NVIDIA could easily drop 10% in 1 or 2 days. NVIDIA was down 15% intraday on June 9th. Netflix was down 10%. Apple was down 9% in 3 days. And so forth. And some have recovered, but some others have not recovered. There's another question that I think many investors overlook. They say, look, the Nasdaq is at a new all-time high. It's exceeding the high in the year 2000, but it's driven by stocks that were not even in the index in the year 2000. In other words, Google went public in August 2004, Netflix in 2002, Facebook in 2012, Salesforce in 2004. These stocks were not even in the index in 2000, and stocks like Intel and Yahoo, they're still about half as high as they were in 2000. Technology is vulnerable to innovation and to new competitors, and we don't know whether the current stocks, the FANG stocks and related stocks that have driven the index higher, if the typical stock hasn't gone up a lot, whether these stocks will still be in business in 5 or 10 years' time.
So you had doubts about that sort of thing. But, Mark, a lot of people look at how much the market has run up since Donald Trump's election last November and how technology in particular has benefited. Virtually all sectors have. Are you saying that the Trump effect is over now, or what?
Well, not necessarily. What I'm saying is, if you look, for instance, at today's market action, the leaders that were pushing the market higher this year, like the high-tech stocks that I just mentioned, Amazon, Netflix, also Tesla and so forth, all these stocks were down today. And even if someone is very bullish on stocks, I think a change in leadership could occur or has occurred. You look at European markets as an example. All the European markets have essentially outperformed the U.S. this year in U.S. dollar terms, except for the FTSE in Britain, because the pound was so weak. But other markets are up between 16 and 20%.
And you see that trend continue to play out? You see that trend continuing to play out? And if so, then what are you buying in this environment? What do you recommend investors listening to you now do?
Well, I would rather buy European stocks than U.S. stocks because the profit margins in Europe are much lower than in the U.S., but they seem to be recovering, and the news out of Europe is not exactly brilliant. Don't misunderstand me, but it's starting to improve somewhat. So I think that European stocks, given their lower valuation than U.S. stocks, I mean, Dan Loeb, he bought the big stakes in Nestle, the Swiss food company. These kind of stocks are reasonably priced when you compare them to the prevailing interest rate in Europe. In the case of Nestle, it yields 2.7%. In Switzerland, the 10-year bond has a negative interest. So you have some cushion of safety in the U.S. The Treasury yield still over 2%.
All right. Mark, thanks, I think. It's always good tapping your fine brain. Marc Faber, the Gloom, Boom, and Doom Report. He's one of the most celebrated market soothsayers out there.